Good morning, everyone. This is Fan Yang, Assistant Director of William and Stephanie Foundation. We sincerely appreciate you for being with us today. Firstly, we want to acknowledge our generous sponsors for this webinar, which are WS International Group and Asian Inc. For those audiences who need language interpretation service, please follow the instructions on the screen. Please note that Mandarin Chinese language interpretation are available at this time. You may keep staying on the English channel if you don't need interpretation service. Firstly, please allow me to briefly introduce the webinar organizer, William and Stephanie Foundation. William and Stephanie Foundation was established to assist underserved communities of all ethnicities. Its founders, Daniel and Ling Sieu, come from a long history of service to the community. The role of William Stephanie Foundation is the bridge between the federal and state governments and the various ethnic groups that comprise the Asian and ASEAN communities. In addition to promoting economic development of minorities, William and Stephanie Foundation also initiates and organizes positive energy events, such as cultivating teenagers' social responsibility, increasing public awareness of environmental sustainability, local scholarship program, and music healing therapy. Compared to material abundance, we believe awakening everyone's dream and having a beautiful mind is more important. Also, since today's webinar topic is 2022 US real estate, please feel free to enter your questions in the Q&A tab. Our keynote speaker, Dr. Dolf de Roos, will pick up those questions in the Q&A session. Thank you. Our next guest speaker is State Treasurer Fiona Ma. Honor Fiona Ma is California's 34th State Treasurer. She was elected on November 6, 2018, with more votes than any other candidate for treasurer in the state's history. She is the first woman of color and the first woman CPA elected to the position. Let's welcome Treasurer Ma to give her opening speech.
Thank you very much. Thank you very much. And I'd like to thank the William and Stephanie Foundation for putting on another very interesting and important and pertinent webinar. Over this pandemic, I myself in my office have personally done about 300 Zoom webinars, and we've done at least 24 with the William and Stephanie Foundation, really reaching out to those underserved communities, API, Asian communities who don't typically have a lot of access to information, experts. And today with Dr. Dolf de Roos, we have a very special opportunity to hear from someone who has been in the trenches for many years, have seen many downturns and upturns, and I personally look forward to hearing what he has to say about the future of real estate post-pandemic. In the state of California, we offer many programs. We offer many loan programs for small businesses. Some are going to be rolling out in 2022, so stay tuned with my office as well as the governor's office. We also have first-time home buyer opportunities in the state of California through our California Home Financing Authority, as well as our California Veterans Authority. If you're a veteran, we also have very favorable rates so that we can help you get into your first home. And for next November 2022, we are hoping to put an initiative on the statewide ballot that will put the state of California in a position to help with first-time home buyers with down payment assistance. We understand that that has been the biggest barrier for low-income folks to buy their first home is being able to save that 10, 15, or 20% of the value for the down payment. And so we are working at that report and that study at the Treasurer's Office, and hopefully we can see more homeowners coming in 2023. So if you have any questions or need any assistance, please do not hesitate to reach out to me. My email is askfiona@treasure.ca.gov. I will put that in the chat. Again, askfiona@treasure.ca.gov. And as your state banker, I am very, very happy that California continues to be the 5th largest economy. We thank everyone who is contributing to the well-being, the economic stability. And as we start opening up, I look forward to continuing our global relationships with our partners. So again, thank you very much for being here. And I look forward to hearing from Dr. Dolf de Roos. Turn it to you.
Thank you, Treasurer Ma. Thank you for your wonderful speech. Our next guest speaker is Daniel Sieu, Chairman of William and Stephanie Foundation. Daniel has worked directly and indirectly with MBDA since 1997. He has spent the past few years building relations with the consulate and the communities of the ASEAN countries, which are Association of Southeast Asian Nations, as part of his long-term strategy of building overseas relations, identifying development opportunities, and bringing in minority contractors as participants. Currently, his team is reaching out to ASEAN countries to assist the business owners in becoming familiar with applying for government assistance programs from the federal and state government. Let's welcome Daniel.
Thank you, Fan Yang, and good morning to everyone. We're very happy that all of you are sticking with us and following our webinar series. I know that we're getting really close to the holidays, and all of you probably want to just kind of slip into the holiday season without more and more webinars and business-related matters. But we thought this is a very important subject, especially among the Asian community, having to do with real estate. And fortunately, we were able to bring in Dr. Dolf de Roos to speak about real estate because, as you may have seen or you will soon know, he's worked with the best real estate gurus, not only in the US, but throughout the world. He's consulted with, I believe, 14 different countries throughout the world. And he's just a wealth of knowledge, not only just basic real estate, but how do you reposition your portfolio or a specific piece of real estate. He knows so much about the future trends, which is vital to all of us coming out of the pandemic, hopefully. And just so you know, he actually, we had him as a guest speaker at William Stephanie Foundation fundraiser the other month. And he was surprisingly well accepted by all the guests at our event, including the Indonesian Consul General of Los Angeles, who they've been able to establish a great rapport. So a little about Dr. de Roos. He's a professor, writer, and investor of real estate. Dolf teaches at events and institutions in over 16 countries, including Tony Robbins Wealth Mastery and Trump University. He also worked with Robert Kiyosaki for a number of years and wrote books in the Rich Dad Advisory series of real estate. He's an acclaimed book, real estate. His acclaimed book, Real Estate Riches, was on the New York Times bestseller list over 7 months, and is passionate about the psychology of wealth in general and real estate in particular, and more than willing to share the fruits of his ongoing quest for knowledge. So please welcome Dr. de Roos.
Well, thank you so much. Thank you for your kind introduction, Daniel. I appreciate it very much. Thank you too to the William and Stephanie Foundation for organizing not just this event, but a whole series of events. I know I watch them with enthusiasm because I have a theory that you never learn less. And even if you read a book or sit in on a Zoom meeting, and there's only one thing that you actually get from that, that one thing that you learn can set you, in financial advantage for years to come. So thank you, William and Stephanie Foundation. And in particular, thank you, Madam Treasurer, State Treasurer of California, Fiona Ma, and for so graciously doing an introduction for us and participating in this. And I really want to take the time to express to the listeners, both live listeners on the Zoom call, on the Facebook feed, on the YouTube feed, but also those who might listen to this in the weeks and months to follow. Something that State Treasurer Fiona Ma said, I think is really important, and that is that the state of California is providing assistance for first home buyers. There are loan programs for people buying real estate. And I really want you to accept this in the terms of what is really going on. Many people say that with prices, real estate prices being as high as they are, it is more difficult than ever to invest in real estate or even to buy a home to live in. And I want to give you a bit of a reality check to start the session off. And that is, I've got articles that if we have time, I can show you later. But one article was in a very reputable magazine. It's Time magazine. I think you'll agree it's quite reputable. And Time magazine claimed that the era of buying real estate as an investment has come to an end. And that article appeared in 1947. That's more than half a century ago, at a time when prices for houses were hovering around $2,500. I've got articles from Business Week dating back to 1969 saying that the era of a home as an investment where you can actually generate some revenue with it is finished. It's behind us. That was 1969. I've got articles through the decades where everyone has predicted that real estate will never be good. And just yesterday, I had the pleasure of driving down from where I am now in Orlando, staying with some friends. I drove down the coast to a place called Sebastian and met with the owner of a motel who was looking at selling it. And she related the story that she sold a home, I believe it was in 2013. It was on the beach. It was obviously a beautiful home, and it sold for $5 million, and how she was very happy that she sold it for that price, because $5 million is a lot of money in anyone's terms. But that she saw recently it had sold again for a staggering 18 million. And that is why I want to share with you that when your state treasurer is giving incentives and financial inducements and assistance to people, be it first home buyers or people buying residential or commercial property, we're living in unprecedented times. Just about everyone that you know and yourselves, you all have one of these things, a slab of silicon that is not only a phone, which is how they started off. We even called them a mobile phone. But these things now, you can book air tickets on it, listen to radio stations from anywhere in the world. You don't have to be in line of sight of the local AM or FM station. You can listen to any station anywhere in the world, watch TV programs, book airfares from anywhere to anywhere. You all know the story. And we get news from all over the world. You can look at real estate anywhere. Look at the technology we have. We're on a Zoom call now, and you're probably watching it. State Treasurer Ma is driving in her vehicle. You might be driving, you might be on an aeroplane, you might be at home, you might be at work, you might be commuting. But wherever you are, we have the ability to join forces and share information. And we have the ability to look at real estate, not just beyond the confines of your own home and driving distance from your home, but elsewhere in your city without having to travel there, in other cities in your state, in other states, even in other countries. It's all possible now. I think we're living in times that are better and brighter than ever before. And our price is high? Yes, but everyone has always considered prices, when they look at them, to be high. From June 2021 to June of 2022, in that 12-month period, prices on average in the United States rose an average of 31%. That's unprecedented. We'd never had an annual average increase in real estate values of that high. But we're not the only country. In fact, we didn't even top the list of countries with the highest rates of increase. I believe that award, if you want to call it that, that dubious distinction, be it good or bad, it could depend on your interpretation, went to New Zealand, but just about every wealthy nation on this planet, every Western nation, had massive increases higher than before. And, you know, a question I most frequently get asked, and maybe I'm preempting it by suggesting it here, is, Dolf, prices have risen enough. Isn't it just like back in 2007, 2008, when we had the GFC, the global financial crisis, when we had a big run up in prices and then they collapsed? So to set the scene for what I'm going to talk about, I want to address that directly because I think it's relevant to all of us. And my answer is, firstly, I don't know the answer. I cannot predict the future. I believe I have a crystal ball, but history has shown my crystal ball to be no more accurate than anyone else's crystal ball, meaning I truly can't predict the future. But I do truly believe that circumstances today are completely different from what they were in 2008. Let me explain why. In 2008, there was a lot of money around. We had two kinds of loans which fell into disrepute. One was called a no-docs loan. In other words, you could apply for a mortgage without needing any supporting documentation. So that is a no-docs loan. And the other one was a stated income loan, meaning you didn't have to prove your income to justify a mortgage. You just had to state what your income was. And you could state, for instance, that your income was $1 million a year, and the bank didn't mind because they would give you a mortgage based on your $1 million a year income, be it real or not, on the basis that no matter how big a fool you were to buy that property for, say, 3 million, in a year's time, there'd be an even bigger fool to pay even more money for it. And that tended to happen. So we had this tremendous buildup in liquidity, and money available to buy. Mortgages were easy to get. However, there was a surplus of houses. And when you had a surplus, there had to be a crash. And the difference between that situation and today is, today there is not a surplus of residential properties. In fact, there's a chronic shortage. And it's estimated by all the statistics bureaus that right now there's a shortage of 4.1 million housing units in the United States. So again, money is relatively easy to come by. Interest rates are the lowest they've been in decades. And yet we've got a chronic shortage of homes. Even if all our major home builders operate at full production, it's going to be difficult to bridge that gap between the demand for homes and the supply. So with a shortage of homes and easy money, of course, prices are going to rise. And in general, those of us who believe in the sort of capitalistic world that we live in rather than a very regimented world, we know that that is good for the economy, because if we put restrictions in place, restrictions on home values or selling prices, or restriction on rents, they tend to have the inverse effect of that intended. So I don't believe we're headed for a crash. To preempt the second question we'll get, what's going to happen in 2022? I really don't think the increases are going to be as steep as they've been in the past year, but I don't think they're going to crash. Again, I could be wrong. The crash might have started as this call started, but I don't think so. I think there are going to be increases, but at a slower rate than in the past year. I'm thinking somewhere between 8 and 12% across the board, which is still extraordinarily high. And by the way, I'm talking on average. And if we have time, I want to talk a little bit about averages, because one could argue that statistics are just a group of numbers looking for an argument. And I think people use statistics for the wrong reasons all the time. But I want to show you statistically why I believe it's easier to beat the average in real estate than in just about any other investment. So with everyone's permission, what I'd like to do now is share my screen, because I think we've all seen this screen slide now. So I will share this page here and see what comes up. Okay, and I'll even put it in play mode. So hopefully you can all see a book on the screen, and if I can get a thumbs up from someone that you can see that. Yes, okay, so we're good. So this is the book that Daniel referred to before. This is Real Estate Riches. This came out as part of the Rich Dad's Advisor series. And this book, you'll see it's been translated into many languages. Here it is, for instance, in Bahasa. Many people in America don't know where Bahasa is spoken. Bahasa is the language of Malaysia and Indonesia. Indonesia is the most populous nation in the Southern Hemisphere, 280 some million people. And it is a tremendous market for people looking at doing business there, or even looking at doing real estate deals there, or bringing investors to do real estate deals here. And so that's a great market for us. And here is the book in Korean. And by the way, I love how America has this very open policy towards real estate investment. It's not restricted to citizens. In fact, when you buy a property, at that point, you don't even have to declare your citizenship. And I think it leaves for a very free-flowing market, which I endorse. And here it is in Japanese. I was fortunate enough as a kid to learn Japanese, so I've done a bit more work in Japan, perhaps than other parts of Asia. Here it is in Greek. And to give you some perspective on the Greek economy and whether you should be investing there, I have never received a royalty payment from Greece. And I find that interesting because, as we all know, their economy has been in some significant trouble. They're having disputes with the EU as to whether they even qualify to be in the EU. So my point is, I've got a lot of books out there in a lot of languages. I think I've written 23 books now. Here is some of them. And I'm not showing you this to impress you at all, but just to show you that a lot of my life has been devoted to the study of real estate, mainly investing in real estate as a participant, but also to share what I'm finding. And here I've got audio courses. This one happens to be in Japanese. I've got lots of other audio courses in English and other products there. And I've been featured on some magazines. This was a New Zealand magazine. Here I'm featured in a US magazine. And you can see the big 38. I thought at first, are they predicting my age, which was completely wrong. And then I thought, are they predicting my IQ? And it's also wrong. It's just the page on which the article appears. And here I am on an Australian magazine. And then here I am in an Indonesian magazine. Again, this is in Bahasa. On this magazine, they call me the #1 international property guru. And again, I'm not showing you any of this to impress you, but to let you know that I have spent a lot of time in all these places, particularly Asia. I love it over there. I'm not just saying that to pander, but I think there are real synergies of being able to do business between the two countries for the benefit of both parties, by the way. And, you know, as Daniel and Ling know, I truly believe that for any deal to be successful, everyone has to win. The more a deal is lopsided and it favors one party, it favors the buyer versus the seller, or the borrower versus the investor, then it's not a good deal. You want a deal to be such that it doesn't only seem good from the perspective of today, looking forward, but in 5 years' time, we can all look back and say, yes, that was a good deal. And on that note, I'll never forget when I first went to Japan to look at doing a business deal. And I was this young newbie in the world of business, sitting across the table from 7 senior people. And they looked at me and they said, tell us, how will this deal benefit our grandchildren? And I remember thinking, I didn't say it, but the urge was to burst in saying, who cares about our grandchildren? That's decades away. It's a good deal for us. Let's just do it. But the more I reflected on it, the more I realized that when we take a long-term view, and a long-term view, not just on the merits of a deal or the profit of a deal, but the benefits to all the parties involved and how society may change, then we develop the ability to do better and better deals that have a much chance of long-term success. So this was all good lessons for me. And then I've had the benefit, these are going back now, we all look a lot younger in these photos than we did, but some of you may remember the name Brian Tracy and Robert Allen, Keith Cunningham, and these are all people in the public arena that I've had the honor and the privilege of doing business with. A lot of these were in Asia, by the way. This was an event I did in Malaysia with Jim Rohn. For those of you who don't know, Jim Rohn is the grandfather of the public speaking industry, probably one of the most gracious people I've ever met. He's passed away now, unfortunately, December the 5th, I think 5 years ago. But in fact, that's just a couple of days ago. But I had the real honor and pleasure of speaking with him. And in fact, there we are together. That was down in Kuala Lumpur. And here I am with Brian Tracy and Robert Allen. We're holding each other's books. So again, I'm just giving you some perspective on where I've come from to formulate these opinions. This is a very young me in that photo. teaching at Wealth Mastery when I first started doing that. And then I most recently taught at Tony Robbins' Wealth Mastery. I presume many of you are familiar with what he does and who he is. And down in Singapore, not that long before COVID affected us all around the world. And here, just to finish it off, this is Jay Abraham. He's known as the world's #1 marketing expert. We went on tour. This was, I think this one is in Vietnamese. So we did a tour of Asia as well. And here I am in a room and doing what I love, which is just sharing information. I love sharing information where people perhaps weren't aware of it. And suddenly by following along, they say, oh my gosh, I never realized this. So that's sort of my passion. Here I am in Manila. And this was the last event I did before COVID set in. We had 3,200 people in the room. And at one stage, I was a professor of real estate at the University of North Texas in Denton, which is ironic because my own PhD wasn't in real estate and it wasn't even in finances. Full disclosure, I did my PhD in electrical engineering. I worked on sonar systems. I modeled dolphins for years and bats, and we made equipment like spectacles for blind people or heart monitors for surgeons. And it's sort of an interesting realm, but the reason I got into real estate is because I realized that as a long-term play, real estate had a number of benefits. So much so that I was already teaching real estate. I was already, I had quite a few books out, and I had a meeting cancel on me. I was living in Phoenix. I'm still based there, by the way. I've been in the US some 20 years. Why do I say that? Because you probably can tell from my accent that I wasn't exactly born in Texas. I've got a mixed background. I was born in New Zealand, but my parents were Dutch. I went to school in 6 countries. I've got a really mixed background. It's both good and bad. The good side is that I've been exposed not only to many cultures and languages, but I've also been exposed to many ways of doing real estate and many ways of doing things, which if we have time, we can touch on. But the significance of this book here is I had a meeting cancel on me in Phoenix, so I jumped on a plane to go to Vegas. Nothing good or bad about that. Vegas is only 37 minutes flying time away from Phoenix. And I got back just in time for my office to be closing. It was about 5 o'clock. And as I walked into my office, a lot of my staff were leaving and they said, Dolf, where did you go for the afternoon? And I said, well, I went up to Las Vegas. And they said, wow, do you gamble? I said, no, I don't gamble because the real jackpots are in the suburbs in the form of real estate. I said, what I did do, though, is I bought a house without using any of my own money, and this house is cash flow positive. And my staff looked at me as if I was from another planet. And I guess in a way, in their eyes, I was from another planet. And they stood there with their arms folded and said, but you can't do that. And it dawned on me that if my own staff thought it was impossible to buy a piece of real estate without using any of your own cash and having it cash flow positive, if my staff thought that, then probably the public at large would think the same thing. So I determined there and then to buy 1 house a week for an entire year using none of my own money, all cash flow positive, and I made the announcement publicly. Well, I can tell you, I regretted announcing it publicly because after 4 months, I'd only bought, I think, 3 homes. It was much harder than I thought. But as you also all know, real estate is very cyclical. It goes up and down. And I also had to learn new systems because the tools and tactics you use to buy houses without any cash in the deal is different from when you have 20 million in your bank and you want to buy a good investment. You just have to learn a new set of skills. So as time went on, I got better and better at it. And in the end, I ended up buying 3 houses in one afternoon and would sign the contracts on the hood of my car in the car park of a Starbucks, 3 in a day. And I ended up buying my 52nd home within 9 months. And just to give that some measure of significance, it is possible to buy 52 homes in 9 months in a human gestation period, in the time it takes to make a baby, basically. And so I published the book, and this book details how I did it, where the houses were, what they were. We've got photos of the houses. And even when this book came out, some of the reviewers and critics said, no, you can't do that. That's impossible. Agents must have sold houses to Dolf cheaply just to get their name in the book. And by the way, that never happened. I never said if you sell me a house cheaply, I'll get your name in the book. If that were to break out as a story, I'd never live it down. These were all bona fide, genuine homes. So my point is, this is possible. And a question that you should all ask yourself, it comes from Tony, is what would you try if you knew you couldn't fail? What would you be willing to take on? And that's a lot of what I do, is I try to change people's mindsets about real estate. And just to show you that these weren't all horrible old homes, here I've got a few examples of some of the homes that comprise the 52 homes. And I think you'll agree, they're not terrible homes. The photos aren't that good. They're not even quite straight. But anyway, it just goes to show you can do this. And does it work on any day of the week in any economy? No, you have to pick your timing right. But over a period of years, you can pick certain sectors and certain economies to do really well. Now, my real passion, and as I understand it, the focus of what today's talk is to be about, is more about commercial real estate investing. And there are just some tremendous advantages of commercial real estate over residential, in my mind, that make me want to focus kind of exclusively on commercial in my own investing. And I'm happy to go over them here. This is a book I did on commercial real estate. I wanted a different title. I am blessed in that I've had some of the world's biggest publishers back my books. I've had some published by Time Warner. I've had one published by Time Life, which is an extraordinary, prestigious publisher to have a book published by. Unfortunately, they went out of the publication business. And I've had a handful done by John Wiley & Sons, the biggest and oldest publishers in the world. This one was done by John Wiley & Son, and I debated with them as to what the title could be. And there's another book on real estate. I haven't even read it, but I love the title. And the title is My Dad Thinks I Rob Banks. I love that title. And compared with that, this one is very, I think, boring, commercial real estate investing. But as they pointed out, it's very descriptive. So I want to give you in the next 5 minutes a summary of the advantages that I list in this book. And firstly, just generically, if I can share with you why I think commercial real estate is so good, I will take some pleasure in doing that, because it's a stark difference. And that is, when you deal with residential property, you are dealing essentially with people. I know there are contracts involved, like a residential tenancy agreement document, but in general, you're dealing with people. So the tenant will call you and say, yes, my toilet is blocked. And you'll say, what on earth are you putting in the toilet? That's the 3rd time this month. And they say, well, that's none of your business, but get a plumber to fix it. And you say, yes, I'll call him right away. So you call the plumber and he says, I can be there tomorrow at 4 p.m. And you call the tenant and say, how about tomorrow at 4 p.m.? And they say, no, we're busy then. How about Wednesday at 10 a.m.? And you have to call the plumber back. You get the impression you're dealing with people. Now compare that with commercial real estate. With commercial real estate, you of course also have people involved. You've got tenants involved and appraisers and inspectors and people who go around checking things. But in general, you're dealing with contracts. And the main contract is the commercial lease agreement. And the commercial lease agreement delineates everything that's going to affect your leasing of that property. So I like the fact that commercial deals with contracts. To me, it's just easier to know what was said because you can refer to it rather than rely on your memory. So in that context, though, if it's all right, I want to go over quickly the 9 advantages of commercial real estate as I see them, because if you'll agree with those, then maybe you'll think, maybe I should look at commercial real estate. So let's get straight into it. And Fan Yang, are we going at a good pace? Are you happy? Do you want me to take a breather? Do you want me to see if there are any questions already?
Yeah, I think we are in good pace. We can continue the sharing.
Okay. And if you have any questions, get ready and write them down. Fan Yang will go through them and filter them and start sharing them shortly. Because the last thing you want to happen is that we finish the call and say, oh, there's that question I wanted to ask. So here we go. The 9 advantages of commercial real estate. Number 1 is simply lease duration. In most residential tenancies, occasionally you get 2 or 3 years, but usually they're for 1 year. And either they are renewed for a year at a time, or after the first year, they go month to month because it's just easy and it happens. Whereas with commercial real estate, typically the tenants want a long-term lease. In fact, the most frequent call I get from my commercial tenants is something like, Dolf, can I please get a 5-year extension on the lease? And I'll look it up and I'll say, 5 years? But you've still got 4 years to run on your current lease. And they say, yes. Anyway, getting back to the question, can we please have a 5-year extension on the lease? And you have to ask yourself, why do they want a 5-year extension when they've still got 4 years to run? And the answer is it has to do with their goodwill. Their clients come to those premises. They don't want to have to change premises because then half their clients wouldn't know where to find them. They want to move they don't want to move all their machinery and equipment and stock and plant and an inventory. They just want to stay there. So lease durations tend to be much longer for commercial tenants, which means it's much less frequent that you have to find a new tenant. I love that. Advantage number 2, an assignment of lease. When your residential tenant has signed up for, say, a year, and halfway through they say, listen, we've got a new job opportunity. We want to leave, but we've got this lease, but we found another couple and they're willing to take over our lease. Most residential landlords say, okay. But if 3 months later, the new tenant doesn't pay, you can't go back to the original tenant who moved out to Michigan or Massachusetts or whatever. No, you're stuck. If the new tenant doesn't pay, then you've got a problem. Whereas with most commercial leases, if a tenant sells their business, then they can't just move out and have the new business owner move in. There is what's called an assignment of lease. And you as landlord get to approve that assignment. You can veto it or approve it. And if it's approved and the new business owner, the new tenant, fails to pay the lease fee, then you can go to the previous tenant. This is like magic. So I once had a shop. It was a fish and chip shop. But I had the business sell 5 times in a 2-year period. And interestingly, it sold for a higher price each time. But that meant I had 6 tenants lined up to pay the rent. So if the current owner and the most recent purchaser of the business didn't pay the rent, then the next one would have, and the next one. So you can understand rent was paid every day for every day that lease lasted. So you just have assignments of lease. This is the norm in commercial leases. Number 3 is the outgoings. Outgoings is a term we use to describe property taxes, insurance, and maintenance. With most residential tenancies, the landlord pays the outgoings. So you might collect rent from your tenant, but from that rent, you, the landlord, have to pay property taxes, insurance, and maintenance. Most commercial lease agreements around the world stipulate that with commercial properties, it's the tenant who will pay the outgoings. And if there are, say, 3 or 8 tenants in a building, then they pay their pro rata share, pro rata meaning in proportion to the area that they occupy. So that's a tremendous advantage. Number 4, the tenants earn their income on the commercial property. So they have a vested interest in keeping it looking good. They'll often call and say, can we paint it? Can we remodel? Can we do this? Can we do that? So that's to my benefit. They are spending their money on my building and they do it willingly. That's an advantage I've never had with a residential tenant. No residential tenant has ever said, can I build an extra bedroom or put in a new carport or something? So it's a tremendous advantage. Number 5, not only do they make improvements, but if they want a big expenditure, like $100,000 for a new glass front wall, they sometimes will say, well, would you mind paying for it? But the lease agreement also states that if I agree to pay for something, they'll pay extra rent based on a percentage that's stipulated in the lease, a percentage of the cost. So let's say this wall costs $100,000 and they don't want to pay for it. They want me to pay for it, but they'll pay 6% extra in rent. They pay $6,000 a year extra, in other words. Well, to me, that's a good return. So I can spend the $100,000 and get the extra 6%. I'm happy with that. Or by spending $100,000, the value will often go up by more. I'll get a loan from the bank for the $100,000. I'll pay the bank 4%, but I'm collecting 6%. I'm earning 2% difference, arbitrage, on money I didn't invest. It's great. I love it. And then number 6, we're talking about the advantages of commercial real estate over residential. It's the certainty of rent. When it comes to commercial real estate, it is delightfully and correctly operated on by the laws of supply and demand. It's a capitalistic market. So if You can put anything in the rent agreement that you want. So if a tenant doesn't pay the rent, you can charge penalty interest, or there can be fees. And if he hasn't paid after a certain number of days, you can take over the premises and reclaim them and rent them out to someone else. Whereas we all know, and I understand why, but when a residential tenant doesn't pay the rent, you can't take such strong action. In many parts of the world, including California, you have to wait a certain number of months before you can even take any action. And sometimes the tenants know this and they milk the system. And that is why if a tenant leases or rents both his home and his office where he works, and he doesn't have enough money for both, he's only got enough money for one, he's going to pay the commercial rent, not the residential rent. So you've got much greater certainty of rent. I love that about commercial. Number 7 is you've got ratchet clauses. Notice the word ratchet is one word. It's not two words, ratchet. It's a ratchet clause, which means that at worst, the rent will stay the same at a rent review. It can't go down, but it can go up. It's sometimes also called an upward only rent clause. And that's sort of a very useful thing to have. The advantage for the tenant, you may think, does the tenant have an advantage in that? Well, yes, because commercial landlords can offer a lower base rent when there's a ratchet clause than when there's not. So you've got much more certainty of income. You know that the rent is not going to go down at the next rent review. The only way the rent could go down is if the tenant doesn't renew and you can't get a new tenant at that same amount for the premises. Usually that might happen in a down economy. So that's a tremendous advantage. Number 8 is there tends to be less government interference in commercial leasing agreements than in residential. And I'm not passing judgment on this. It's just an observation that when it comes to commercial real estate, usually there are very few laws, either federal laws or state laws, that affect the operation of commercial real estate. Whereas many states and many countries have quite severe restrictions. I know in the Netherlands, for instance, there was rent control to the point that I had an aunt living in an apartment for the princely sum of $38 a month, when market rents were about $3,000. And that's because she'd lived there for 45 years. And I said, do you like living here? She said, no, I can't stand it. I said, well, why don't you move? She said, because the rent is so low. So it's one of those things where it wasn't really market rental. And then the final one we talk about is management overhead. You know, when I have commercial properties, warehouses, storage facilities, you name it, even offices, the management overhead is rather small. But with residential, I get frequent calls from residential tenants, sometimes about valid things and very often about things that you wonder, why would they call me about that? So there's just a lower management overhead. And again, I'm going to take a break to see if there are any questions, but just so that I recognize it's not all plain sailing, they're not all advantages. There are also 2 downsides of commercial real estate. Number 1 is it can be more difficult to get a tenant. Right? When you have a house that's vacant, a rental house, usually the only challenge, if it's been vacant for a month, is that the rent is too high. Drop it by $50 a month or maybe $100 a month, come down to market levels, and you'll probably get a tenant pretty quickly. But on the other hand, if you've got a commercial premise, office or a workshop, it might have been vacant for 8 months and it has nothing to do with rent. It's just the wrong building and the wrong location for the wrong time, or no one wants a tomato cannery anymore, or thrift shops are not popular in that area. So the trick is, you know, can you get a tenant? And the other disadvantage is that in general, banks offer a lower loan to value ratio, or sometimes it's called LTV, loan to value ratio, on commercial than they do on residential, meaning banks typically easily lend 80% on a residential property, but on a commercial property, they sometimes only lend 50% or 60%. Now I say sometimes because even SBA, the Small Business Association, they've got programs where if you are an occupant of at least 50% of the space in a building, they will give loans of up to 90% on commercial real estate. So there are always ways around this. And part of the fun I have in running courses to teach people about real estate is how to solve these 2 problems. Because if I can solve these 2 challenges you see on the screen now, how to get a tenant and how to get a lower loan to value ratio, then I think you'll agree that we've solved a lot of the challenges. And I've got some slides here on how to attract a tenant. I don't think we've got time to go through those now, but maybe just before we go into the Q&A session, I'll show you a few photos of deals we've done. Here's one. This is going back a while. For instance, this is a building. I wouldn't even call it beautiful, but remember, when it comes to real estate, we're not after beauty. The true beauty of real estate is not in the building. So it's a very important point, folks. The true beauty of real estate is not in the building. It's in the balance sheet. Does it make money? You don't have to look at it every day. It just do the tenants like operating their premises there. This was a funeral parlor. I think you all know what goes on in a funeral home. They process dead bodies. They put hollow stainless steel tubes in the bodies and suck out the blood and replace it with formaldehyde. They have a viewing room and a chilling room. It's not very pleasant to think of, but it had been vacant for 3 years. Did I buy a vacant building? No, I don't want a vacant building. But I did employ someone to phone every funeral director going further and further away from this building until they found someone who said, yes, I want to operate there. So I offered them a lease subject to me buying it. They signed the agreement. And then I tried to buy the building and I succeeded. But it was already worth more to me than it was to the tenant because it had more to me than the seller because it had a tenant in place. Here's a shop. I can show you the original one, a horrible little group of 3 shops in a row. But I bought this one at 21% return. And then before long, I improved it and it was generating about 30%. That's what it was like, a little bit done up. As I say, these buildings don't have to be beautiful. The balance sheet has to be beautiful. Here's the smallest commercial building I've ever bought. Many of you are thinking you need a lot of money to do commercial. This one was 52 square meters, about 500 square feet. I bought it for $80,000. It's not much. It's cheaper than most houses. And it's been tenanted every day since I bought it. It was generating 10,000 a year, about 17% yield. The bank appraised it at 56,000. I didn't have to put much cash in. That was a great deal. And just to finish it off, here's an old factory we bought and turned into student accommodation with movie theaters inside. And to give you an idea where if you have some creativity that can really help you, here you'll see a lane beside this building and it's just gravel on the ground and horrible old bricks. And it's just ugly. I think you'll agree it's ugly. Notice the building across the other side of the road because it's the only thing that's going to stay the same. And we turned it from that into this. And this became a restaurant, which we called the Minx. It had the highest rental per square foot that had ever been achieved in that city. And all we did is we paved the gravel and we cleaned up the brickwork and put some tables and chairs in and planters. And I think you'll agree, I'll go back. That's what it was like beforehand. This is what it was turned into. And we generated massive revenue from that horrible old ugly alleyway. And, you know, I've got plenty of examples of buildings we've done. We did an event in Bangkok, Thailand once. Some of you will recognize this as the Chao Phraya River. And we took our students out on a cruise on a boat. And we noticed this building here on the left, this tall one. This used to be the Furama Hotel. But as we got closer to it, we noticed that it had been abandoned. It was vacant because there were chips of concrete falling down. And even a cubic inch of concrete falling on your head can knock you out and kill you. So it was vacant. We made some inquiries. It was on the market for 21 million after converting from Thai baht. Do you want to spend 21 million on this? Well, it depends on what you could do with it. It needed a coating to stop the concrete falling off. Well, in our group, there was a man from Wisconsin who was involved with an epoxy coating for earthquake strengthening. To keep the story short, he got a quote from his head office by fax in the day fax was very popular for 4 million. The total cost was 21 million to buy, 4 million to repair. And it became, and I've got it here, it became the Millennium Hotel and Hilton, and it sold for 55 million. So it's just, what can you do to a commercial building to increase its value? Here's one that we bought for 17 million. We only did one thing to it and sold it a year later for 44 million. And all we did is one thing. We didn't even paint it. All we did is get a tenant for it. Now, it happened to be a good tenant. It was a government tenant. When the government is your tenant, the only way they won't pay the rent is if they go broke, and then you've got more problems than a tenant not paying. So it's so interesting how you can do these things. I've done oil deals because oil is a real estate deal. And down in Arizona, I even had 148 acres of land in the desert, which wasn't very good for anything. So I started digging a hole. And here you can see the hole I dug. I had 3 shifts of 8 hours a day for 3 months, digging a hole that just became bigger and bigger. And here you can see it from the helicopter. It was a long, straight hole. And when I finished digging the hole, I started filling it with water. It took about 3 months to fill with water. And here you can see it filling with water. And the end game, of course, was to have a set of water ski lakes that we built houses around. And the 48 acres of land we lost to water was more than compensated for by the increase in value of the land. So it just goes to show it's a whole wide range. I'll give you one more because it's so much fun. You know, there were a lot of sheep farms around at one stage. Sheep meat was popular, but then they fell out of favor. A lot of them went broke. I bought the sheep farms and converted them to vineyards. And the value of the land went up by a factor of 10. So the message I want to give you is, firstly, commercial real estate to me is a lot more fun. You're dealing with contracts rather than people. Secondly, you can do things to commercial real estate to really change what it is. And here I am. The irony is I own vineyards and I don't even drink much wine. I'm just not, it's not for moral reasons or religious reasons. I just haven't found many wines that I think, oh, that's delicious. The way I like coffee, for instance. And I've got plenty more photos to show you. Here I am doing events in Vietnam, and you can see they have my photo on billboards all over the city. It got to the point where I'd walk into a coffee shop there and they'd speak to me saying, oh, you're the man on all the billboards. So it was a lot of fun. Anyway, I think I've chewed through a bit of time, and Fan Yang, I'll stop sharing. And I want to see if any questions have come through or there are any loose ends I can tie together for people.
Thank you, Dr. Dolf. It's great to learn from you and your wonderful presentation. Now, if any of our audiences have particular questions about U.S. real estate in 2022, this is your best time to ask our real estate authority, Dr. Dolf. We will choose up to 3 questions, depends on our time left, since this is a 1-hour webinar. So.
So maybe I'll start by saying, Fan Yang, that, you know, lots of people talk about hotels. And when the pandemic started, many hotels weren't doing well because people weren't traveling. And some went into bankruptcy. They couldn't pay their own financing bills. Some smart people bought them and converted them to other things. I can give examples of hotels that have been converted to storage facilities, or hotels that have been converted to assisted living. Some hotels were converted from places where you spend the night when you're away from home to places where you spend the day when you're at home, but you don't want to be at home because everyone's on a Zoom call, including your spouse and the children for school and the dogs there and the cats there. So you just want to go to a quiet place with private restroom facilities. That's why WeWork won't work, because you've got shared restrooms. But that phase is coming to an end. The market is so dynamic that when you're wide awake and you're seeing what's happening, you can take advantage of that, not by taking money from people unscrupulously. You're actually solving a problem. They willingly pay.
Okay, so our first question from Mary, and she asks, Dr. Dolf, do you have any advice in investing in the Philippines?
Oh gosh, yes. So firstly, I love the Philippines. I love going there. One of the friendliest places on this planet, and so polite. I really do enjoy my time there, and the food, of course. The big challenge with the Philippines for me is the exchange rate. So if you are a resident of the Philippines and you intend to live there permanently, then it won't bother you so much, because even if the exchange rate relative, say, to the US dollar goes down by 10%, your purchasing power in the Philippines essentially has remained the same. But if you are living here in the US and you're thinking of investing in the Philippines, then you have to take account of the exchange rate, because if the property goes up in value by 15%, but the value of the peso, the Philippine currency, goes down relative to the US dollar by 10%, then you've only made a 5% gain, and that's barely keeping pace with inflation. So I think the biggest factor you have to take into account is the exchange rate. And of course, it's difficult to predict that. I would say there's a strong advantage in investing in the place where you intend to spend most of your time in the next decade.
Thank you. Our next question is, post-COVID-19, more and more business decide to work remotely. Will this effect affect commercial real estate market?
So firstly, I agree with the sentiment that because of COVID, more and more companies are encouraging people to work remotely. And so will it affect commercial real estate? Yes, it will. But there are a few things we have to keep in mind. Firstly, when we had COVID and everyone was working remotely, I think a lot of people thought, this is great, I love it, because I don't need to commute. I'm saving that half hour, or for some people, 1.5 hours in each direction in the commute. It's wasted time. It costs gas or electricity to get to work. This is great. But after 3 or 4 months, I think many people didn't like it anymore. They don't like being stuck at home all the time. They miss the contact with other people, and their spouse, as I alluded to before, or their roommates or flatmates, they were also at home, school children learning remotely. It became, they wanted to go back out there. Secondly, the thing that makes it a bit less important than you'd otherwise think is that the market has already absorbed it. A lot of commercial space has been taken out of commercial circulation and transformed into residential or storage or other things. So the market's already compensated a bit. And we don't know what's going to happen right now as we stand December 2021. We've got this Omicron variant. Is it real? Is it not? Is it going to take over or not? But there is still an uncertainty, but the general consensus is people are sick of working at home. So I think the effect on commercial real estate is going to be less powerful than we otherwise thought.
Thank you. Our next question is, hi, Dr. de Roos. How do you think about Texas real estate now?
Oh gosh, well, I've lived in Texas, as you know. I was a professor there for a number of years. I love the way many Texans think. They've got tremendous tax incentives, not only when it comes to state income tax levels, but also when it comes to incentives. So I read today, ironically today, that Tesla, the motor vehicle company, has completed its move and shifting its headquarters from California to Texas. And I don't say that, I'm very much in honor of the fact that the California Treasurer, the Honorable Fiona Ma, has helped introduce this event. But I think that is one thing Texas has done very well, is it's attracted a lot of people. FedEx has moved its headquarters to Texas. Toyota has moved its headquarters to Texas and has paid for some 10,000 of its staff to move to Texas. This is a tremendous thing. So, you know, I've got a personal challenge with the weather at times, the humidity in the summer and the cold in winter. But that's, I mean, you get weather extremes anyway. Even where I live in Phoenix, it gets ridiculously hot in summer. So I just say that in jest. I think many states are going to wonder why they didn't follow Texas's lead in attracting people to its shores. But at the end of the day, you know, everything's going to balance out, because if enough people move, their prices are going to go up to balance out again. So it's a personal choice. I wouldn't shift my headquarters to Texas necessarily, but I would certainly consider Texas over and above other states when it comes to investing in real estate, because there's more growth there. Whether we like to admit it or not, real estate is very much something that if it doesn't depend on growth, it thrives on growth. In fact, there's a very strong correlation between capital value increases and population increases. And I'll give you a stark example. Japan, much as I love the country, I speak the language, I've been there 40 some times. I love the food, I love the culture, I love how safe it is, I love how clean it is. Their population, however, is in sharp decline. Currently about 127 million. They think that within one generation, it's going to drop to below 80 million. That's a dramatic increase. Now that's going to be good for getting rid of congestion on the roads. It's going to be good for getting rid of pollution, but it's not good for real estate values. And that is why I choose, reluctantly, but I choose not to invest in Japan, in real estate. Now, on that basis, one would be smarter to invest in Texas, which has a lot of growth, than a state, no judgment here, but something like Wyoming, which is beautiful, right? Yellowstone, a beautiful state, but it doesn't have the same population growth.
Thank you. Next question, would this presentation be available or emailed to us? Oh, that's a question for us.
Yes.
Great question. I will get to that in a minute. But for now, our last question for Dr. Dolf will be, how can we discover any good commercial real estate in California? That's our last question. Thank you.
Oh, well, I would give you a few clues. Firstly, you may live in California. You don't necessarily have to invest there, but every time there's a company, maybe like I just mentioned, Tesla or FedEx or Toyota, that relocates out of California, they vacate a lot of buildings. And when a building is empty, that means it might be hard to get cash flow from it. So I wouldn't buy a vacant building that used to be occupied by Tesla or FedEx or what did I say? I forget the other one, Toyota. I wouldn't necessarily buy them vacant, but I would see if you can find an alternative tenant. Because remember, if you can find a tenant for a building, the value goes from not very much to a lot, because with commercial real estate, the value of the building is a multiple of the income it generates. And so it's just a matter of finding a vacant building and figuring out who can I put in there. Now, do I always succeed in getting a tenant? No, but it doesn't matter because I haven't committed to buying it. But if I find a tenant like the funeral director who wants a particular building, then I can go ahead with the purchase. And usually the bank will finance the purchase price because with my tenant in place, the building is worth so much more. So I would look for buildings that are vacant in California, and don't be discouraged by the fact that they're vacant. Don't buy them yet or offer to buy them yet, but see if you can find a tenant for these commercial buildings. And if you can buy the building cheaply because it's vacant, but you already have a tenant in place. It's a great way of doing it.
Dolf, can you give everyone your contact information as well so that they can get a hold of you?
Can do, or perhaps the best way is to go through the Williams and Stephanie Foundation. It's on your screen. Just go to info@williamsandstephaniefoundation.org. That way you've got some way of monitoring that, and then we can get back to see if there are any synergies there. Obviously, you know, I work with people. One of the things I'll do for people, I just did it for a group of developers out of Thailand, is they will pay for me to go there and look at their entire portfolio to see if there are any ideas we can come up that will increase their value. And you might think, wow, Thailand is a long way to go to have a look at a portfolio. But we did that recently in Jakarta, and after one day, we already increased the value of their building by $2 million. And if we have time, I'm happy to share how we did that. And you know, in Thailand, we did a similar thing. I think we got a $5 million lift there for our 1 week stay. So, you know, if you have one house, the chance of achieving something like that is a bit less. But if you have a portfolio, that's one thing we can look at doing. But I'll be doing that in conjunction with the William and Stephanie Foundation. So the best way is just to take a screenshot of what you see now, send an email there, and let them know what you're interested in, and then someone from the foundation will filter that through to me.
Thank you.
Finally, thank you so much for joining our webinar today. Also, special thanks to our interpreter, Daniel Drum, for his language assistance, simultaneous interpretation service. If you have any questions about this webinar or have any questions in general, please email info@williamstephaniefoundation.org. Again, our email is info@williamstephaniefoundation.org. We will also upload this webinar recording on YouTube for your reference. So please do subscribe to our YouTube channel, WS International Group, which is on the screen, should you want to get more fresh information on new programs of the US real estate. Thank you, and we look forward to seeing you soon.